maybe to start, we could just go through the different types of sort of risks or shocks that can impact the market. And, within each of those, we can sort of discuss the type of assets that may or may not do well. And then, we can kind of get into some maybe non-standard techniques about how we manage sort of some of that risk. So to start, do you want to give a little primer on the different types of shocks that we can sort of experience in the market and what might drive them?
Sure. So I think the first thing to acknowledge is that, we're going through a period of high volatility in the market right now. And everybody tends to want to talk about these risk management strategies after the fact. Everybody tends to, I remember in 2008, everybody wanted to be invested in the permanent portfolio, which we'll talk about in a little while, but everybody wanted to be invested in that after the decline because it was down only 2% in 2008. So I think it's important to acknowledge that the time to be implementing these risk management techniques is probably not after the decline has happened. And you saw that in 2008. A lot of people implemented these types of risk management techniques and then they didn't work for a really long period of time. So, these should be implemented as long-term strategies. They shouldn't be implemented just following crises. And it's important to acknowledge that because people tend to implement these at the wrong time.
That is a great point.
In terms of shocks, there's two different types of shocks. And, in my career, we've only seen one of them, but the other one does exist. One is a deflationary shock. And 2008 was a deflationary shock. What we're going through with the coronavirus right now is a deflationary shock. And what works in those types of things is very different than what works in an inflationary shock. And, it's really been the 70s, early 80s since we've had any kind of issues with inflation. So most people are not familiar with inflationary shocks, but it's just important to acknowledge that during these inflationary shocks, what's worked in a decline like the one we're seeing right now probably would not work if it was an inflationary shock versus a deflationary shock. So I think it's just important to acknowledge both of those, although we'll probably be talking mostly about deflationary shocks because in modern times, that's mostly what we've seen. It's important to acknowledge they both exist and that what works in one is not going to work in the other.